As the most pressing concerns over the banking sector have largely faded, equities have surged to nearly approach the highs for the year. Still, the threat of a shallow recession remains, with regional banks likely pulling back on loans to small and mid-sized businesses. Yet we don't see elevated inflation cooling at a pace that would lead to easing from the Fed this year. In response, we have increased our tactical portfolio positioning to high-yield bonds and natural resources. Let's take a closer look. Inflation in March continued to moderate. However, the Federal Reserve more closely watches core inflation, which excludes volatile food and energy prices. Core inflation actually inched up slightly, supported by persistent services prices. After the Fed and European Central Bank moved rates higher in the past month, the market expects the Fed to hike just once more based on futures trading. The ECB is expected to continue hiking until mid-year. In our view, the increasing risk of a mild recession in the U.S. will limit the magnitude of the Fed's rate hike cycle to perhaps 1 or 2 more hikes. While the market expects the Fed to cut rates by year-end, we think that once the Fed reaches its peak rate, it will hold steady for the rest of the year. If inflation falls more quickly while the labor market maintains durability, investors can draw up an optimistic case for stocks. But gains in equities this year, against a backdrop of falling earnings expectations, have led to valuations that provide limited upside in the base case. With negative economic forces accumulating, including the recent banking issues, we believe the balance of risks leans negatively after the recent run we've seen in stocks. We see better risk-reward in high-yield bonds because of attractive yields and our view that any possible recession in the U.S. will be shallow and short-lived given the solid condition of corporate and consumer balance sheets. As a result, we increased this month our overweight to high-yield bonds in our global policy model, which guides asset allocation in our portfolios. We moved U.S. equities to a small underweight and deepened our underweight to emerging market equities, with the sluggish economic reopening in China and continued global political issues limiting valuation upside. We added to our overweight in global natural resources, where we see attractive valuations and supply-side discipline supporting prices. Our tactical positioning is largely neutral overall, but we expect elevated market volatility with an uneven trajectory of economic growth and inflation.